Welcome back to the show. Today we have Mark Volchek. He's the founding partner at Olas Venture Capital. Mark, welcome back to the show.
Yeah, thanks for having me.
Yeah, I'm excited to have you back on the show. You know, it's been a while, and I thought, should have you kind of on this version. I think what you guys are doing is actually really innovative, and I always kind of found it interesting because you had basically building the future right on your kind of homepage of your site. So, but maybe before we get into all the fun stuff that you're doing, let's get to know you a little bit better and start off with where you grew up.
Sure. Yes, I grew up in Queens, New York.
Okay.
And spent a few years in Europe where I went to high school, and then came back to the U.S. and went to Yale University in Connecticut, and that's where my entrepreneurial journey started.
Okay, so walk us through kind of your career, maybe some career highlights up until kind of the VC firm.
Sure, yeah. So it was really mostly one company. So as a senior in college, so I had some jobs in college, and I actually ran a home improvement business while I was in college. But then senior year, I started Hire One with two other colleagues, and we essentially took Hire One through 5 rounds of funding. We did a private equity transaction in 2008, and then we took the company public in 2010.
Okay.
And we built the company essentially from 3 college kids in a dorm room to about 1,000 employees, $250 million of revenue, over 60 million of EBITDA, and over $1 billion of market cap. So it was for us, a pretty exciting roller coaster. And so I really did that from 2000 when we started the company to 2014 when I decided to leave the company after 15 years. I was burned out, and it was time for me to, take the break and do something else.
Sure. So what did you end up doing, and then how did you kind of get back into the VC world?
Sure. Yeah. So I basically left my full-time role at Hire One.
Okay.
I was CEO. We hired a new CEO to replace me. I stayed on the board. But the only way I could really disconnect was to literally sail into the sunset. So I bought a sailboat, and I literally went sailing on and off for about 18 months.
Wow. That must have been amazing.
Family. And yeah, that was a really cool experience. After 18 months though, I was kind of done with sailing. As exciting as it was, it wasn't as exciting as it was day one, after a year and a half. And it was really kind of on and off because I still was on the board. I was a bunch of other boards. And so I would sort of, spend a few weeks on the sailboat and then come back for a few weeks to do business and then, disappear again. And that was really good. Sort of recharge the batteries, take a break. And so I was done with sort of my sailing expedition, 4th of July weekend of 15. So the summer of 2015, I was sort of back. And I was ready to think about what I want to do next. And interestingly, one of the folks who had brought into Hire One, who was our sort of adult supervision, or our CEO, who we brought in 2002, and stayed with the company through 9 years.
Wow.
And he helped us really through all the formative phases of Hire One. He had left the company in 2011 and had also moved to Florida.
Okay.
So, part of the sailing thing was also moving full-time down to Fort Lauderdale, where I'd had a place since 2007, and sort of, being full-time based here. Dean had actually moved to a place very close to Delray Beach, also in Florida, independently. Okay. And so when I was sort of done with my sailing, I kind of got together with Dean and said, what do we want to do next? We loved working together. And we said, he was too young to be retired. I was way too young to be retired. And we said, we got to do something. And we started getting involved in the startup ecosystem. So we got involved in some of the angel groups. We had been doing angel investing since 2008.
Okay.
Initially, really just felt more charitable, where we're just supporting entrepreneurs, and we kind of would write small checks and hope that people would be successful. We over time actually got smarter about it, and we actually started doing a little bit of work and would help the entrepreneurs, even take some board seats. And so we decided to continue that in South Florida. What we realized, though, very quickly was the biggest risk for an angel investor in South Florida is follow-on funding risk. Because you're writing a small check, the angel group might write a check as big as $500,000 or $750,000. But if there's nobody there to write the next check of, call it $1 million or $2 million, the company can be doing great and still fail.
Sure.
And so we said, wouldn't it be more better from an investment perspective to write that next level check where nobody's really operating today, and we can see more, progress with the companies and only pay a slight, upcharge in terms of valuation. So it's a valuation arbitrage. You're sort of getting a year, maybe more of information and only paying 20 or 30% more than the early angel investors.
Interesting.
And so that felt like a good trade-off for us. And we didn't want to just invest our own money, so we decided to go out and raise a fund. We met some other folks through our angel investing activities that joined our efforts. So we now have so I have 3 partners. There's 4 of us total.
Okay.
3 of us are operating partners, and our 4th partner is really on the fundraising side.
Okay.
Since he's been a private wealth manager most of his life, and so that's really how we put the fund together. It's a $30 million fund,
wow,
approximately, and we actually have a little bit more than that under management with some of the special purpose vehicles that we do as well for some of our investments where they exceed the capacity the fund can do.
Sure. So what types of things do you guys kind of invest in? Is it specific verticals, or how does that kind of work?
So we're somewhat of generalists, but at the same time, we probably mostly focus on B2B type businesses. So it's more around who the customers are and less about real verticals. So we like companies that have, where sales is important and not necessarily marketing, right? They always go hand in hand. But, B2C companies often have big marketing spend and more of a binary outcome. We're generally looking for companies that might have, 10 customers and are looking to expand to 1,000 customers. We generally like, businesses that have, average revenue per customer of $10,000 or more per year. That said, we look at stuff smaller. We love stuff that has $100,000, average revenue per customer. So it really depends on the business. And so we generally feel like we're generalists, but at the same time, we do veer towards things we understand or know better. And that's things like fintech, ed tech, enterprise SaaS, things like that. And it often, we don't know what we understand until we see it, right?
Sure.
So it's a little bit of art more than science.
Right. So is there specific geographical regions that you try to invest in, or are you kind of spread out across America, or how does that kind of work?
Sure. So we generally want to invest in areas where we can be active and it's accessible. So generally what that means to us is mostly East Coast.
Okay.
And certainly the closer to home, the more we're maybe willing to explore something, deeper. If something's 10 minutes from our office, we may take a first or second meeting just to see if there's something there. Right. Versus if something is in Chicago, it's a pretty high bar for us to say, where did it come in from? Why do we like it? So in terms of focus geographies, we're kind of focused on Florida, Atlanta, and New York, just because we have a lot of network in New York from our prior business relationships. That said, we'll look at stuff elsewhere, and we have a company in Memphis, and we're looking at some deals in the Midwest. Often it comes down to how the company came to us, because in geographies where we're not active and we don't go to regularly, we worry about sort of negative selection, that only the leftover stuff comes to us. Whereas in Atlanta, we make a concerted effort to be there 1 week a month. So that makes us almost like locals, and one of the partners will be there. We now have 2 portfolio companies in Atlanta, and we're building that relationship there with the sort of local ecosystem. And the same in New York. So we try to be in New York once a month, and that allows us to build some of those relationships better than it would if we were just virtual in some sense.
Sure. So for people that are looking to maybe get funding from you guys, is there certain things that they need to kind of show you? Like I get like a pitch deck, but is there specific things that you guys are looking for in kind of those materials or that presentation that, are kind of like you guys always kind of look for?
Yeah. So I think generally, there's sort of 2 sets of criteria as I would think about it. One are the sort of screening criteria. If things come to us and we're sort of just trying to figure out if it's worth taking a first call or first meeting. And those are generally around initial traction. So 1, we look for, is this a business we understand? Is it something that makes sense to us? But 2, is there initial traction, initial customer adoption? And what we're really trying to prove is sort of product market fit.
Right.
But for us, that generally means $500,000 of ARR to maybe $1 million of ARR. So that's annual recurring revenue. And again, it's not a hard and fast number, but generally we feel like if customers are paying $500,000 a year, then, you know, there's a real business and we can diligence that. We can talk to the customers. There's probably a pipeline. So that's one thing we generally look for is traction. We have invested in a few opportunities where there hasn't actually been real revenue, but there were contracts, a big contract backlog.
Okay.
So again, we're looking for proof of product market fit. And then we're generally looking for something that's scalable and defensible. So that's where those criteria come in. You know, once we like a business and maybe we take a first call, what we're really trying to evaluate is the management team, the business model, and then defensibility. And that's really often the most difficult for entrepreneurs to get across to us as an investor, is to explain to us why the next person down the street can't just copy and do the exact same business just as well as they can. And sometimes it's something proprietary they have or something that's actually defensible about the model. In other cases, it's about the entrepreneur themselves, that they are just the perfect person to execute on this vision and on this business because of their background. So in a few of our cases, the founders or entrepreneurs are experienced business people in their field. They may be first-time entrepreneurs, but they have a background that makes them perfect to execute the vision they have. And that's one of the ways businesses become defensible. It's not always about, the technology or patents or IP. Sometimes it's just the right person in the right place at the right time. But that is part of the story that we often, have a hard time getting entrepreneurs to explain to us.
Sure. Well, and I would also assume that since you guys, there's 4 of you and you've been in the game for so long, just helping the companies you invest in put together like an advisory board or some other kind of just like have board members is probably really kind of beneficial, I think, right? Is that fair to say?
Yeah, absolutely. So one of the things, we generally like to be a lead investor in a round. So we might write $1 million check in a $2 million round. So we help bring in other value add investors, but we also generally ask for a board seat so that we can be helpful. We can help build proper governance and really support the entrepreneurs in what they need. So it's not about helping them run their company because the entrepreneur knows the company better than we do. It's about those events that entrepreneurs don't do very often. So maybe it's raising the next round of funding. Maybe it's having an M&A inquiry that, an entrepreneur's never dealt with an M&A before, or it's hiring a VP of sales or the key hires. We often find ourselves most helpful when we invest in the early days is helping with, making sure we hire the right people and then subsequent fundraising. But then in some cases, we also get a lot of ongoing sort of, people ask us for strategic advice on the business as an outsider. So we'll never know the business as well as the founder, but sometimes having an outside point of view is very helpful. And so that's one of the other things. And then bringing other relevant people to the board is sometimes, important, but often the entrepreneurs know the industry better than we do. So they actually know the industry experts, and we can often help them bring those people on board and structure the right compensation for those people as well.
Sure. No, that makes a lot of sense. So what should people kind of look for in a VC firm?
Yeah, so I think that's a great question, and something I think not enough entrepreneurs think about is, picking the right partner. Because ultimately, if the business, is successful and continues to grow, most likely the entrepreneur and the VC will be partnered for, 5 or 7 years or longer. And so having the right partner is really important. And so one is certainly personality fit is important. 2 is the background of the principals and how they operate together. And I think what we have is somewhat unique there is that, all 3 of our operating partners, myself, Dean, and Esteban, we've all been entrepreneurs. And so we see it from the entrepreneur's perspective. Right. But also the way we work together is very, very collegial. So taking money from Olas VC, you essentially get the benefit of all the partners, not just the one partner that's sitting on your board. And we try to very consciously all be up to speed on all our portfolio companies, which is hard to do. So
Sure.
one of us is always the lead, but
Mm.
when a company has an issue, we use Slack and, we just post something and say, this and this company is looking for XYZ, and everybody responds. So we're very, very collaborative. And even like in Atlanta, we take turns making trips to Atlanta once a month. So even though I may not be the lead on a company, when I'm in Atlanta, I'll still meet with the company and see how I can help them, see what they need. They get a different perspective. And so I think those are all very good questions to ask a VC as an entrepreneur is, how do you work together? What's your internal culture like? Who's going to be my primary point of contact? You want to make sure that, you don't get sent to a very junior person and then you may never see the partners again after you take the check. There's lots of bad stories. And so it's important to check out the VC, talk to references, talk to other entrepreneurs who've worked with, the investor you're considering taking money from. Obviously, if you don't have many choices, the most important is to get the money in the door. Right. But many good entrepreneurs have choices who they take money from. And I believe personally having professional VCs as investors can add a lot of value if you have the right people in the right, circumstances.
Sure. So is there like a magic number of companies that you guys like to say, like, we only do like we're working on like 10 at a time or 20 at a time, or does it not really matter with kind of you guys?
So certainly from a fund perspective, we think about how many portfolio companies do we want to have in a fund? And there's sort of two sides to that. One is portfolio construction. So as a VC, you worry about having sort of too many eggs in one basket. So we do want to have some diversification. So our goal is to have 15 to 20 companies. So we, can have some winners, but if some companies don't work out, that's okay as well.
Sure.
At the same time, we also need to be able to carry the workload. So if we have sort of, call it 3 to 4 people who can take board seats, and we probably have, we're the lead and have sort of true board seats in maybe half of our deals. So that would mean maybe 10 or 12 board seats between 3 or 4 people. That's manageable.
Right.
At the same time, we have to start raising fund 2 at some point. We have to continue to look for new investments. We have to do diligence on new investments. So it's sort of how do you balance all those different workload issues? And today we have 1 associate. Likely once we start raising fund 2, we'll hire another person to sort of leverage, the partner's time. But it is really important for us to think about, how many can we do without sort of spreading ourselves too thin? So we think less about like how many deals we work on, but more about how many portfolio companies can we support. And again, that's a 5 to 7 year commitment to these companies. So that's really how we think about it. But it's important for us to also be an ongoing enterprise as a venture capital firm, not just a fund.
Sure.
So it's important for us to think about when do we need to start raising fund 2 so we always have a fund to deploy and don't have a gap. So that the pipeline we're building, we're always talking to entrepreneurs. We want to be in a position to write checks when we find opportunities that merit that.
Right. So, and I'm always kind of curious about this is like, as you mentioned, say like 5 to 7 years, hypothetically, right? Is maybe like year, like 3 to 5, do a lot of the companies traditionally need maybe less of your time where they might just need you guys for like a week or 2 or a few months a year? And then they're kind of on their own for a month or 2. And maybe they have like some emails or something or calls, but where they're not constantly needing your time without maybe just some few questions. Like, do they get to that point traditionally or how does that kind of work?
Yeah, so we don't have a lot of firsthand experience with that yet, given that the fund's 2 years old. But I think in general, we are not that active even in our existing portfolio companies. We do get emails and, when there's a transaction going on, I might talk to the entrepreneur every day. But in a normal case, you talk to them once or twice a month and maybe a few emails. But I do agree that once they've raised the next round of funding, often the next lead investor will take a bigger role and there'll be more people around the table. So that should be less workload to carry. That said, my experience as an entrepreneur on our board, we actually never really had anybody leave. So our first institutional investor was Hensiatic Corporation, and Paul joined the board in 2002. And he was on the board through 2016, was actually chairman at the end of the, as the company was maturing as a public company, he became chairman of the board. And that's because he knew the company well. We trusted him. We liked Paul. And so I think part of, our hope, but also what's going to create more work for us is that entrepreneurs really want us on the board. So even though they don't need us, they still want our time, and they want as much of our time as they can get, even if it's 5 years in. And even, compared to people who may have just put in $25 million checks versus our $1 million check, it's about the value you add. But I think realistically, there will be some early, successes, some early failures. And so our 15 to 20 companies might get whittled down to 10 pretty quick.
Right.
And then the 10 is where we'll spend our time for the next 5 or 7 years. So I think that's kind of how we think about it. But being a new VC and only in business for 2 years, we still don't have a lot of data on that. So we're sort of developing that as we go.
No, that's interesting. So we're kind of coming to the end of the show, but I really kind of want your thoughts on what advice do you kind of give entrepreneurs, maybe at the early stage or kind of throughout their, maybe a little bit of veteran entrepreneurs, because you've kind of been one, but you're also on the VC side. So there's got to be something that you probably maybe hear all the time or see all the time that you'd maybe like to tell people.
Yeah, sure. I think one of the, as I think about one of the things I'm frustrated about in some areas, and I think it would be good to understand as an entrepreneur better, is, how much money and when is the right time to raise it, which is a really, really difficult question. But part of what I'm seeing is that the size and timing of rounds is often driven by the lack or the abundance of capital. So giving you two extremes, and I'll talk about the sort of middle, where it's probably the right answer, is, when we came to Florida a few years ago and started getting involved in the ecosystem, what we found was people bootstrapping for too long. So people essentially would bootstrap and do on their own for years. They wouldn't have the capital to hire people. They were trying to do too much, too long on their own, and they would miss the boat. So 3-4 years later, your great idea may not be as great anymore as it was, because other people in Silicon Valley, which is the other extreme, have raised tens of millions on an idea, even though they're the wrong person to execute on it. They don't really know how to do it, but they have so much more money, they can just hire people.
Sure.
And so my view is it's somewhere in the middle. It's really important to bootstrap and get to a certain point before raising capital. But when you feel like your business is ready for expansion and you've figured out sort of how your business is going to work, at that point, it's really critical to bring in enough capital to really execute on that vision quickly, hire people. It's important to overhire because people take a while to get up to speed.
Sure.
Some people may not work out. So it's really important, if you need 5 salespeople, to maybe hire 8, knowing that a few might not work and somebody might leave. And that's hard to do if you don't have enough capital. So it's really important, I think, at the time when you feel like your business is now ready for scale and you've worked out the kinks in your product and it's ready to go, then to raise enough money from the right capital partner to really make it happen. Because if you wait too long, somebody will pass you or the business will become stale, and it becomes hard to do when you've been doing it for too long. And I think that's a fine balance. And particularly in the geographies where we operate, where there isn't sort of a lot of capital, so there's more of a lack of capital, we see entrepreneurs sort of scared of raising money or shying away from raising money or getting advice from people not even to try because it's too hard. And I think that's the wrong advice. It's somewhere in between. Get as far as you can, but when you feel like the time is right, then go out and raise the money.
Yeah, no, that's really good advice. I think a lot of people struggle with that. So I think that's really good advice. But Mark, we're coming to the end. So let's close with mentioning where people can get more information about you guys.
Sure. Our website is the best place to go, and that's lasolasvc.com.
Perfect. And it's LASOLAS and then just the VNC.com. Yeah. Perfect, Mark. Well, I really appreciate you taking the time out of your day to be on the show, and I look forward to keeping in touch with you, and have a good rest of your day.
Yep. Thank you. Thanks so much. Thanks for having me.
Thanks, man. Bye.